and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. Well, as each passing day brings more and more despondent news on the economic front, it's hard to remain optimistic. If in the past the signals were mixed, today there's hardly any sector of the economy that is doing well. Auto, telecom, power, banking, NBFCs, real estate, the list is long and growing. The fact that the PM Modi chose to speak with Economic Times, this channel's sister publication, rather than to a general newspaper, in his very first interaction with the media after the elections, is perhaps a reflection of the seriousness with which government now views the situation. What, if anything, can the government do to arrest and, if possible, reverse this slowdown? Joining me in the discussion are three experts. Saugata Bhattacharya, Chief Economist, Axis Bank; Surjit Bhalla, the well-known and outspoken economist, guaranteed to liven up any discussion, and also former member of the Prime Minister's Economic Advisory Council; and R. Jagannathan, Editorial Director, Swarajya Magazine. Welcome to the show, Saugato, Surjit, Jaggi.
Thank you.
Let me start by asking all three of you, how severe is a slowdown? The RBI's latest monetary policy statement reduced the first half growth quite sharply, but put overall GDP growth for the year as a whole at 6.9%. That's not a bad number by any yardstick. So should we take heart from the MPC's reading that the slowdown seems to be transitory, or worry that the MPC has got it wrong and the slowdown is actually much, much deeper? Let me start with you, Surjit. Since you're normally an optimist, we'll get into the details later, but for now, how severe is the slowdown, Surjit?
Well, you mentioned the RBI forecast, and I'm afraid that the RBI forecast for GDP growth rates is going the way of its forecast for inflation rates. They have been so consistently wrong, and by such a large margin, it is worrisome. So when you say that they have 6.9, I think as far as the first quarter results are concerned, fiscal quarter, that we will find out at the end of the month. But most estimates, including mine, suggest that it's somewhere going to be below 5.8. And my estimate is close to 5.3. So that is about 300 basis points lower than the 8% that we had just about a year and a half ago. So I think the slowdown is quite severe.
Okay, so Jaggi, Surjit says very unambiguously that the slowdown is very severe. Would you agree with him, Jaggi?
Yes, I would certainly agree, because there are cyclical and structural factors both pushing the economy down. The cyclical, of course, is the global slowdown and the domestic slowdown in several very critical, high value adding sectors like telecom, banking, then you have IT and many other sectors, domestic things. We have seen that happening, and non-bank financial sector, all those things are there. And of course, real estate and construction. So, and the slowdown in government spending in the last 2 quarters of the last fiscal, in order to stay within the fiscal limits, actually must have added and made it this. So I think if you look at purely the rear view mirror, I would say we are heading towards a deeper slowdown. But it's difficult to say that we will not pull back up in the last 2 quarters of the year. But let's see, we'll have to wait and see.
Okay. So, Saugata, what is your reading of the situation? Both Jaggi and Surjit make no bones about it. The slowdown is severe. Jaggi is prepared to kind of give a little bit of hope towards the latter end part of the year. But what is your view, Sugato?
No, I agree with both of them, Mythili. I think there are more expanding structural factors, that is adding to the cyclical factors that Mr. Jagannathan mentioned. So I think there is somewhere a change in the risk perception. I think consumption is getting deferred for whatever reasons. We ourselves have seen, Dr. Bhalla mentioned about the first quarter results. It's actually pretty severe. I mean, the slowdown that we see, and it's across the board. And the thing, particularly the front face of the slowdown, I mean, that people are talking about, the automobile sector. I think from our internal results and from the results that we are seeing across segments, there are very deep embedded structural factors now. The age of buyers, home loaners, the auto loans, the people who are seeking auto loans, The age is increasing. That's a clear structural factor. And there are the other factors in terms of the segments, the aggregators, for instance, which shows a deepening structural factor in the slowdown.
Okay, so not a very cheery way to start a discussion, but Surjit, how do you see the slowdown, as cyclical or structural? Jaggi seems to think it's a combination of both. The reason why I ask you is that if it is cyclical, maybe one can have counter-cyclical policies, but if it is structural, these very counter-cyclical policies could in fact make things worse. So what is your view, Surjit?
Yeah, we have to define what we mean by cyclical and what we mean by structural. Now, do you think, or do the people think that real interest rates is cyclical at historical levels of 2.5% to 3%, on tax rates at historically high levels even compared to the rest of the world? Is that cyclical? Is that structural? I would think it is cyclical, but I want to point out here, whenever I bring these two factors up, and the third factor for demand creation and for growth is believed to be the exchange rate, and a lot of people, I think including you, Mythili, argue for a depreciation of the currency. So let me dismiss that argument right away. There is no evidence. The real exchange rate, according to the BIS, which does it for about 100 countries, has stayed at approximately the same level since 1999. So let's dismiss that argument. Second, on many of my colleagues and many of my friends say we need overall reforms, this, that, etc., and then only, and those are the structural reasons that they point to, and those are the reasons why we are declining and we are not going up, and that interest rates won't do much or tax rates won't do much. So I want to ask all of you, put it right here on the table, that for the last 15 to 18 years, when we didn't have interest rates at such high levels, all right, we didn't have the overall reforms that all of you guys talk about. Those still reforms are pending, and yet we grew at 7-8%. So I put the question to you guys very squarely, who think that these things don't matter, that they are structural. What happened over the last 18 years?
Okay, so Jaggi, let me have you answer that question. Cyclical, structural. Surjit says, how is it that we grew so fast earlier, even when we didn't have these structural reforms? Could it be possible that we've reached the limit and now structural reforms are absolutely necessary? Or is there something more to it, Jaggi?
Yeah, two things. One thing is, there is no point of disagreement on two basic things, that your tax rates need to be lower, your interest rates need to be lower. And these are obvious things, and even though they may not immediately help, they are going to be, they have to be done. When I talk about structural, let me define it. I think it was not the way Surjit put it. I think several major growth and job creating industries like say telecom, finance and IT have gone through very sectoral structural challenges. IT is automating at a big rate, digital is impacting all banking and finance businesses, and telecom has come from 9 or 10 players to about 3+1, including the public sector Bharat Sanchar Nigam. So we are talking about huge contractionary forces in some of the biggest expanding industries of the last 10 years. So and then you're talking about real estate. Real estate is structurally unreformed for several years, and the UPA made it worse with the Land Reform Act, the land things. So you're talking about very huge sectors actually needing deep structural reforms, but the market is forcing these structural reforms, which the government ought to have helped in the advance. So I meant, when you look at it sectorally, that is where the structural problems are. It is not at the level of the macro economy, where of course interest rates and tax rates we can anyway fix. That can be done within 1 year, but the remaining things need a very long-term solutions based, and of course I have left out agriculture, which also needs structural reform. So 5 major sectors which hold so many people in employment are in need of deep structural reforms. Those challenges are what are causing this slowdown, apart from the double balance sheet problem and all those things.
Okay, so Saugata, what is your take? Structural, cyclical, a combination of both?
So of course, I mean, it's a combination of both, that goes without saying. But I'll tell you what, I mean, Dr. Bhalla's question, it's relatively clear. I mean, what were the initial drivers of the initial phase of growth? One, of course, is the global system. which, because of the stimulus, the entire set of stimulus measures across the globe by the central banks and the others, was keeping growth afloat and helping exports to a certain extent. The more important factor to my mind was the delivery of credit. And initially, because of the high lending, high credit offtake from banks, which got many banks in trouble at one point in time, that's when investments started coming down. And lately, over the last 2 or 3 years, the enormous amount of credit that has come in from the NBFC sector. If you just look at the numbers, I mean, from up to 15th of March in FY18, NBFCs delivered almost 2 lakh crores of worth of credit. Whereas in the same period in last year, in FY19, it fell to about 13,000 crores, 2 lakh crores to 13,000 crores, despite the increased offtake from banks. So the proximate reason for the slowdown, and remember, it is only for the last 8 or 9 months that this slowdown has accelerated. Initially, it was slowing down at a rate, but I think these are the proximate sources for what we used to see before, and we are no longer seeing, or even likely we are not going to see in the months going ahead.
Okay, so not a very dismal picture again, really. But Surjit, what is the best policy lever? The normal demand is that monetary policy, and you've spoken of a high real rate of interest. But the point is that monetary policy can lower rates of interest, but how do you ensure that it will spur demand? Is there more space, in fact, for fiscal policy, given that everybody talks, of course, about the fiscal deficit being more than what the budget documents show, etc. But the problem is there are limits to monetary policy. As I said, you can make money cheap, but how do you get people to borrow?
Yeah. Well, there are limits to fiscal policy as well, but it's a good question. Let me first address what Mr. Bhattacharya was saying. Credit offtake, it's very interesting. You look at the credit offtake, and retail credit is growing at the highest real rates possibly ever. What is the problem is that there is no investment demand. There is no investment happening, or there's no increase in the rate of investment. That's the problem. It's not credit offtake because the credit is available. Now, around the world for centuries, people have tussled with your question. We had Keynesianism, etc. What people generally, so let me first directly answer the fiscal side. I think there is room for fiscal expansion, and if it is done through not expenditure compression, but it is done through perhaps a deep lowering of the tax rates. That is structural. Our problem is structural in that we have very high, and this idea that we have to go through one sector, another, we have gone through sectoral changes, everything else. So let's just be real. How much if you want the government to apply band-aids at every sector that has a problem, no. So what policymakers around the world have come to the conclusion that there are 2 levers that they have, 2 big levers that they have. Fiscal is constrained and monetary is the one and only lever they use. So therefore, to use your monetary lever, then see what happens. Lower interest rates by 200 to 300 basis points, and then let's talk what's happening. Is credit flowing? Is investment growing? Is demand happening? Why can't we do that counterfactual both in our heads as well as to the policymakers? Just think, real estate, what do you think will happen to real estate demand if there is interest? The cost, the EMIs do not go down as the banks go ahead and continue making profits and do lazy banking. And all they are lending to is retail, okay? And they're not lowering the EMIs for them when the interest rates go down. So I think we've got a real problem with our bankers and really with our analysts who think interest rates, interest rates matter, but really not. Tax rates matter, but really not. We've got deep structural reforms. Tell me what is the deep structural reform we need?
Okay, Surjit, of course, bankers will tell you that the price of their loans is determined by the price of their deposits, and that's one reason why they can't lower lending rates, really. But we'll come back to the discussion shortly after a break. Welcome back. You're watching Macros with Mythili, and I'm in discussion with three experts on what can the government possibly do to at least halt, if not reverse, the slowdown. Jaggi, before the break, Surjit, of course, was in his usual emphatic self talking about why monetary policy can't be used more effectively. But in the Indian context, the fiscal policy fixation with a particular number glosses over the fact that, in fact, bond yields have come down quite dramatically by over 100 basis points. And there is no private corporate demand. So as long as the real rate of growth is higher than the real rate of interest, and we're able to keep debt to GDP ratio more or less under check, is it not the quality of the fiscal deficit that matters, Jaggi? Why not try fiscal deficit, which can be directed far more effectively than monetary policy, Jaggi?
Absolutely. I am not a fiscal fundamentalist, and I believe that the focus of fiscal consolidation must be on cutting down the non-capital related, non-growth or non-investment related expenditure, or keeping that fixed at a certain level. It should not be about fiscal deficit which promotes investment and growth. The second thing is there is a minor connection, not a minor, a significant connection between what you do fiscally and what happens monetarily. For example, banks are not transmitting interest rates. Why are they not doing so? Because they are now getting risk averse after having burnt themselves silly over the last 8 years by indiscriminate lending. So they are not taking the risks that they need to do it. And why are they not taking the risks? Because you're not recapitalizing them fast enough. If you're going to put 70,000 crores, it makes much better sense to give banks the 70,000 crores this month rather than in March. So then the banks will rediscover their risk appetite. The transmission will be faster because they can write off their earlier bad loans quicker and they'll have the space to lend. So today, if they want to keep their spreads very high, then they are not going to bring down the, even the rates already cut will not be transmitted to the borrower. So before we actually cut the rates even further, we need to first transmit them faster, and that needs faster capitalization, which has a fiscal impact. I think this kind of fiscal leeway we should easily allow, and fiscal leeway for increasing investments in infrastructure, whatever it is. Only the fiscal leeway which goes purely to consumption, government consumption and waste, that is what we need to cut down on. Like you should sell your Air India and your BSNL and hope that they are not a further drain on your fiscal resources.
I couldn't agree with you more, Jaggi. But Saugata, I think you're best placed to answer both what the point that Surjit raised as well as what Jaggi raised. Are banks not being willing to transmit, or is it the fact that the cost of deposits is very high for them? So one can never really have a 1:1 transmission in the Indian context. Saugata?
Yes. So, no, I mean, I will not probably be as blunt as my colleagues, but I mean, let me say this, that I mean, this is not just a monetary policy, interest rate, transmission or otherwise. Cutting interest rates, I completely agree with Dr. Bhalla that I think this is a necessary condition, but I unfortunately think it is not a sufficient condition. It will not work in itself. You need a series of measures. I agree with his other point as well, that I think we are too highly taxed an economy now. I think that's one of the reasons that you are seeing a slowdown in consumer confidence and as well as investor confidence. I think we are too highly taxed at this point in time. We are not getting enough disposable incomes, and particularly with all the uncertainties about jobs, etc. So that's the third part. Second part. The third part is the transmission that comes in. I remember that banks were not cutting rates. We are seeing an acceleration of the actual MCLRs and the actual lending rates now, because remember, we were in a very high structural deficit, liquidity deficit, till about the end of June. It's only in July and in August that we are seeing an open up of liquidity, of surplus liquidity. We expect liquidity, if not to be surplus throughout, at least much less tight in the rest of FY20. So I think banks will increasingly become more confident in transmitting the cuts in the RBI policy rates. And yes, I think it is time now for the RBI. I think globally inflation is probably not going to be a problem. That will diffuse into India as well. The RBI forecast for inflation, let's say. So I think at this point in time, it might be the correct the response, monetary policy response, to take on a little bit of any potential inflation risk and actually cut a little bit deeper than what I completely agree with Dr. Bhalla. Maybe not the 200, 300 basis points, but certainly much deeper than the markets are now currently expecting.
Okay, so Sri, so you got some support there from Saugata. But my point too now is that, is the slowdown affecting only specific sectors, in which case the balm should also be applied only to those specific sectors, or should it be applied across the board because it's all pervasive? And you spoke of high tax rates, but then why is our tax to GDP ratio so low, Surjit?
Mythili, we need a look. Our tax to GDP ratio is not low. It is completely as predicted by research, by comparison with other countries with similar per capita incomes. So let's get rid of that. Another one, sorry, Mythili, you said that the bond yields are down by 110 basis points. Yes, bond yields are down by 110 basis points, and inflation is down by 130 basis points. So the real rate has actually gone up. So let's also not blame the banks for the complete lack of transmission. It is that as Shaktikant Das has done his best with full support from you guys, but not enough criticism, that while he's been there, inflation has fallen by 130 basis points, so he's cut by 110 basis points. Why do people think in nominal terms when all number one element of economics is real? So now let's go back to what Saugata said. He said he completely agrees, exactly, not 200, not 300. Let's take last year. Let's do real rates. So our real rates have not changed at all. So if last year you thought you needed 100 basis points, today you need to think that you need 200 basis points for the same forecast that you had last year. That's how I get 200. And actually I get 300, but never mind. So let's look real, and our tax to GDP ratio is not low.
Jaggi, you've recently written a piece arguing against sectoral balm on the grounds that this leads to vested interests and that it's very difficult to withdraw whatever concessions you've given. But if the problems are sector specific, what is the alternative? Unless you don't think it's sector specific and it's across the board and we need something wider and deeper. Jaggi?
Yeah. Two things. I think I want to make one thing clear, that the structural problems are sectoral. So those need reform. They don't need tax cuts or stimulus. So that is a different thing. When I'm saying if you are offering a stimulus, offer it across the board. Don't say I'm going to give it to air conditioners and not to let's say something else, or autos. I'm going to give it to autos, but I'm not going to give it to somebody else. So don't do that. So if you're cutting GST substantially, do it for all the sectors uniformly, instead of saying I'll give this particular sector that. That's what I meant. But the problems of many sectors are structural. I mean, real estate problem is structural. You have a problem of politicians bottling up land supplies and not allowing land prices to find their natural markets. Obviously, real estate will be beyond reach for 99% of the people. So that is a structural problem. You don't need to give special concessions to real estate. You need to fix the damn sector. That is what I mean by saying that structural and all that. As far as monetary and fiscal, I mean, I don't see much. I think we should not do homeopathic doses of rate cuts. Either you believe that rates are too high and bring them down. Otherwise, people will barely notice. If you say 25 basis, then 35, it does not move the needle on anything. You need a shock. You say, come on, let's cut it by 1% this time and 1% in October, and then suddenly everybody will wake up, the markets will boom, and you will have people raising capital from multiple sources, including the secondary markets. So the point is, there is a way to do it, and there is no point doing it in homeopathic doses.
Okay, Saugata, so are you in favor of shock treatment just when the economy is still not recovered from both GST as well as demonetization? So, or given the fact that we are, as I said, a democracy, homeopathic doses are all we can do. Saugata?
No. So, I mean, remember that, I mean, the ultimate objective of monetary policy is to reduce lending rates. I mean, it doesn't matter whether you do it via repo rate cuts or whether you do it via liquidity infusion and things. It has to be complete. All of it needs to come together as a package. Mr. Jagannathan mentioned about the recapitalization of some of the public sector banks. That will help. Then some of the measures, I don't think it will be a very large part. Some of the prudential measures that have been relaxed for the NBFCs is also going to be a part of this solution. So I think it needs to come together as a package. Of course, the initial thing is the repo rate cut. Liquidity, probably, I mean, if it begins to get into deficit, again begin to infuse liquidity in the system. Maybe very, very prudently some. In this case, I agree with Mr. Jagannathan that sector-specific measures are not good, but maybe something needs to be done with the key choke points of credit, and so all of this needs to come together.
Okay, so Surjit, if you were to advise the government, what would you tell them? What would your top priority be? 1, 2, 3, if you were to draw up a plan to at least halt, if not reverse, a slowdown?
No, I think if anybody is listening, including economists on this panel and the viewers, including perhaps the government, look, there are four, I would phrase it that there's a 4-point program. And first, cut interest rates by 200 basis points. Second, cut your tax rates to back where they were, and for corporate taxes, reduce the overall tax rate to 22%, including exemptions. So there's about a 10 percentage point cut there. Third, I completely agree with Jaggi. You front load, you have an equivalent of a TARP program, or at least give them all the support the banks right now, today, of 70,000 crores or 100,000 crores, rather than doing it in homeopathic doses. Basically, we've got homeopathic doctors making fiscal policy and monetary policy. And fourth, speed up completely the privatization program. And fifth, I completely agree with my co-panelists, do not do sectoral-wise, do macro-wise. And then let's watch. Then let's come to the debate. Then let's see what happens to the economy. If the economy does not boom, I will stop coming on TV, I will stop writing.
Surjit, that's a tough call. But you started saying that you give us 4 remedies and you give us 5. So let me ask Jaggi whether he'd like to add to anything that he has said, because the problem really with Surjit's solutions is that, when we talk about economy, you forget that actually it represents people. So many of these things cannot really be tried with people. It's all right in a lab. So I'm not very sure whether you agree entirely with this prescription or you would like to add it a little differently. Jaggi?
Two things. I mean, I agree broadly with the thrust of it. Maybe the quantum of some of those changes might be a little different here and there. Where I would say is that if you want to improve investment and you need higher savings, and currently there is a deficit of savings in the Indian economy, both in the household sector is saving less, is loading up on debt, and the corporate sector is trying to deleverage, so they are not in a mood to invest. The logical thing is to tap the humongous pool of global surplus savings by selling off large quantums of domestic assets, like say your road things, giving them for 20-year tenures for tolling and other things. You will give you huge amounts of dollar capital. I mean, all you need to do is sell those assets, get them back after 20 years, and you have gone through the next 2 years of low saving and investment, bring the foreign money, then recapitalize banks, and then you will have enough money to carry on after that on your own steam. Right now, you need to tap foreign savings to get domestic investment also pump primed.
Okay. Sogato, would you like to add to that wish list before we conclude?
No, so this is absolutely exactly on what's on my mind. I just want to highlight in fluorescent colors what Dr. Balla said about the tax cuts. I think that's absolutely necessary. Just a little coda to what Mr. Jagannathan said. I think some of the policy flip-flops around, say, the Andhra Pradesh tariffs on renewable power, etc., that sends a very bad signal to overseas investors. So just avoid things like that.
Okay, so we have the prescription all ready for the government, and as always, Surjit has enlivened the conversation. Thank you so much, Surjit, Jaggi and Swagato, for joining me in the discussion. Thank you also for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.